Hi, today we'll talk about the contributors to your credit scores. We'll divide this presentation into two parts to keep them short and palatable. The all important question: what goes into your credit score? And therefore, what can you do to improve it? As you've seen before, there's not one, but multiple credit scores, each with their own tweaks to the algorithm. But the basic principles remain the same. These are the five big players in your score, in order of importance: payment history, amounts owed, length of credit history, credit mix, and new credit. So let's go down the list. The first is payment history, the biggest contributor at 35%. By payment history, we mean whether you are on time with your credit payments or if you are late with them. It considers all different kinds of credit lines, banks and store cards, mortgages, and other loans. A late payment stays on your credit report as negative information for 7 years, and the degree of impact on your score depends on a number of factors. How late you've been with your payment matters. First, credit card companies are allowed to report a late payment to the credit bureaus only if it is at least 30 days past due date. From there on, the later the payment is posted, the worse the impact on your score. Until at 6 months, the credit card company will write off the loss and report the account as charged off, which makes your score drop precipitously. The bigger the amount in question, the worse the impact. Naturally, one late payment is better than repeat offenses. The impact is largest when it first happens and slowly recovers with time, until at 7 years when it falls off your credit report and scores. What kind of impact are we talking about? Since there are so many moving parts, exact numbers are hard to come by. But if you have good to excellent credit to begin with, a single late payment may drop your score by 50 to 60 points, as I found out the hard way by forgetting to pay a $100 retail card bill. Interestingly, if your credit score is not so great to start with, the impact is lower. One is always punished for being good. FICO, the credit scoring giant, performed a study in 2014 of the top quartile of scorers, those with credit scores greater than 800, called them FICO high achievers, and studied their profiles. 96% of them had never made a late payment, as opposed to 57% of the total population. Of those that did, the last late payment was almost 4 years back for the high achievers. The next biggest contributor, at 30%, is amounts owed. It considers balances on both revolving accounts such as credit cards, as well as installment loans such as mortgages and auto loans. But revolving accounts carry more weightage in this category than installment loans. For installment loans, it's pretty straightforward. It's the amount of the loan still owed. For credit cards, amounts owed is the balance you carry from month to month. But even if you pay off your credit card in full each month, the amount owed is not zero. It's your last account balance. Sometimes this is different from your statement balance, since the lender may report your balance to the credit bureau at certain pre-specified times, say the last business day of the month. The underlying concept behind amounts owed is credit utilization ratio. What proportion of the credit limit extended to you are you using? If you are using close to your maximum credit limit, it is a sign you may be stretched too thin and may have trouble paying off new or current loans. Credit utilization ratio is an easy mathematical calculation. Account balance divided by credit limit times 100 expressed as a percentage. You can find both account balances as well as credit limits in your monthly statements. Your credit report calculates the utilization ratio for each of your accounts individually, as well as overall, all accounts combined. The lower the number, the better, though it is worth noting, a low credit utilization is better than no utilization. Without any credit usage, your credit report will have little to go on and your score will start trending down. The FICO study I quoted earlier noted that high achievers had a median utilization of 4% and highest ever utilization of 10% on their revolving accounts. Both numbers were much higher for the total population. A sharp spike in your utilization ratio may negatively impact your credit score to the tune of 10 to 50 points. If you max out all your credit lines, your score could plummet by 100 points or more. How do you lower your utilization ratio? Like any ratio, either by reducing the numerator or increasing the denominator. Some strategies to reduce account balances: the no-brainer option, reduce spending. But if spending isn't a problem, and if your credit card allows it, you can split your payment into two parts every billing cycle, thereby lowering the balance at any point in time. If that's not allowed, you can reset your billing cycle to start right before your balances are reported to the credit bureaus. For example, if they report to the bureaus at the end of the month, starting your billing cycle on the 15th or 20th of the month will help reduce reported balances. Check your credit report or ask your lenders for reporting dates. Yet another option is to pay off a big ticket item as soon as you put it on your card, instead of waiting till the end of the billing cycle. For instance, I pay off the international tickets on my travel card within a day or two of it posting to my account. To increase the denominator, increase your credit limit. Remember, though, that the math will work only if you don't simultaneously increase the numerator, i.e., the spending. Apart from dropping your utilization ratio, a higher credit limit may let you put a big purchase on your card, which may have reward benefits. To increase your total credit limit, you have two options: increase the limit on an existing card or get a new card. To increase the limit on an existing card, you could either ask for one or wait for an automatic increase, which card companies will do periodically for consumers with good payment history and adequate income. Please note, the income you report is not independently verified by the credit card company. Its accuracy is your legal responsibility, which is pretty basic. Don't lie about your income. Credit utilization and amounts owed calculations take into account only the last reported card balances and credit limits and your highest ever balances. So you will want to pay close attention to your utilization right before applying for a big loan, such as a mortgage. I want to point out here that even though amounts owed or credit utilization accounts for almost as much of your credit score as payment history, a high utilization is far more forgiving to your score than a late payment, since the points lost to high utilization are regained as soon as the high balance comes down and is updated at the bureaus, usually in a month. On the other hand, points lost to late payments take years to recoup. We will end this here and continue in the second part of the presentation. Do check it out. Thank you.